Hello.
Hey, I'm sorry. Hey, Mike. Let me. I might sound here. Hang on one second. Uh,
You're a little muffled today.
Can you hear me now?
Oh, much better.
I can't hear you. So bear with me for one
You
second.
sound good.
Okay, there we go.
Yep. Now you
Um,
sound excellent.
Good. Is Kip on or is he jumping on?
He's not on.
Let me,
But
text him.
I'll text him. I sent him the link, but hopefully I sent it to the right location. Actually, you know what? Why don't I just give him a call real quick? Oh, there he is. Hello. Hello, hello. We see you, Kip.
Can you hear me?
I can hear
Yeah,
you.
there we go.
Jesus.
You're like the help desk, the IT help desk now.
Yeah. Yeah, I'd be a little careful about that one.
All right. Wow. They got the gang's all here. Well, half of Greg is here.
Yeah, I'm just boarding my phone so it doesn't ring here. Busy day in the markets here with March going off tomorrow and May getting pushed up here. So
Incredible opportunity, man. Incredible.
yeah, let me share my screen. So can you see? There we go.
Oh, let's do this.
Yep.
So shameless plug again. We have our Risk Academy, Risk Management Academy coming up in the end of April in Nashville. If you have any questions, please let us know. It is starting to fill up. I think we're right around 30 plus people now.
Oh, wow.
So we will cap this at some point just because of space constraints. Let's jump right in. Is there anything going on in any other markets here this last week?
It's been really slow, Jory is actually down at the South by Southwest conference in Austin.
Yeah.
So as you can imagine, there's a lot of chatter about Silicon Valley Bank going on there.
Yeah, and I've got some basic slide decks. I'm not going to dwell on this too much, but it's had a profound impact on just about every market imaginable. And I think you will have the trickle down into lumber from a risk exposure standpoint. And I'll give you my a synopsis, if you will, of what I think this means from a banking sector. But let's jump in. The big thing is we've had extreme volatility to the downside now in equities, and the equities were reeling from last week with Powell literally speaking. Pretty much he spoke last Tuesday, last Wednesday, the market coming to the realization that the Fed was going to go higher, stay longer with interest rates. And so equities were under pressure to begin with, and then you lump in the whole debacle with Silicon Valley Bank's failure, and you've had a pretty profound move in interest rates. And we'll kind of jump in this. So the two markets that have moved the most dramatically outside of equities are our yield curve from last week, and then the U.S. dollar. And you can see it here where the dollar was up in this 105 area. It's cratered back to 103. You've had a pretty substantial move, flight to quality in gold, and kind of looking here. apparently a flight to quality to Bitcoin, because
That's high quality.
yeah, take your money out of the banks and put it in Bitcoin. That seems to be a logical, kind of investment move here. Obviously, the one that jumps out to me is VIX volatility index has gone through the roof. You've had a flight to quality into precious metals. And then when you look at 5-day returns, as yields come down, bond prices, treasury prices inversely move and go higher. So we'll get into interest rates here. But hey, look at the bottom of this list. Lumber, as much as we're getting good deal to death in cash and watching March slide away, May's actually up 2.38%. So this captures the May contract here. If you look at the big losers, obviously you see equities on this list. Here's the Dow, S&P. As the dollar, the dollar's on here. U.S. dollar, crude oil. So you have risk off in some of these other markets. And so literally a week ago, Fed Chair Powell says interest rates are likely to be higher than previously expected, higher for longer. Don't fight the Fed. The idea that the Fed fund rate was going to go to 5.25% to 5.5%. There was talk that you could even go upwards of 6%. When you look at the expectations a week ago, I think it was a 75% probability that you were going to see a 0.5 basis increase on March 22nd at the next FOMC meeting. And then the hit the fan with SVB. And now, so everybody knows Silicon Valley Bank, was the second largest bank failure in U.S. banking, or since, I guess, since the subprime crisis. And the repercussions is there systemic risk in all U.S. banks. JP Morgan put this out over the weekend, and these are all the different publicly traded banks. Obviously, JP Morgan proving a point that we're low risk relative to our competitors. So here's your low risk, here's your high risk, and so banks like Bank of America, KeyBank were down upwards of 40% yesterday. As everybody kind of delves into banking financials to see what kind of exposure that they have. And, obviously the Fed came in and backstopped all of these depositors. Shareholders, you're SOL, but the depositors are going to be made whole on their deposits. So the market has had a dramatic kind of bounce today in equities with the idea that the Fed is going to backstop depositors. And so, when you look at Silicon Valley Bank, the easy answer is they started to have losses on some of their financials and securities. As those securities started to lose, they needed to raise funds to pay for those losses. They went out and did a round of funding that failed. So when that funding failed, their CEO said, "Don't panic," and that's tantamount to running into the theater and yelling, "Don't panic! There's a fire." So the rest is history. And so basically, I think what's unique about Silicon Valley Bank is that they obviously cater to Silicon Valley technology, private equity, to venture capitalists. But when you look at their overall portfolio, basically when you loan out money, that's a liability. So you have to do something on the revenue side. So you invest in short-term securities, long-term securities. And what got them in trouble is that they were investing in 10-year treasuries yielding 1%. There's nothing wrong with that if you can hold them to fruition. The bigger issue is that when you have to break that prior to duration or maturity, then those bonds are worth significantly less than what you paid for, and it unraveled from there. When you have people withdraw $42 billion in one day, That's not a good outcome. It doesn't matter who the bank is. So here we are. And so now, this is the headline this morning. Moody's cuts outlook on U.S. banking system. First Republic yesterday got taken to the woodshed. The government basically, I think state regulators stepped in and locked them down. So now that we're seeing those shares bounce because the Fed basically said we're going to secure depositors. And so I know I'm rambling on here, but when you look at interest rates, a week ago there was a 75% probability you were going to get a half a basis point increase. Now that's dropped to an 85% that it's going to be 0.25%. Goldman Sachs says there's going to be no rate hike come the 22nd. So now we've gone from a almost guaranteed 0.5 to probably a quarter to save face, maybe nothing. Just, you're going to find out how, when the Fed tries to rationalize this, have they pivoted off of inflation? Is this more pressing? And you're going to find that out in the next FOMC meeting by what they do or they don't do. And so, when you look at treasuries, a week ago, 10 years spiked up to 405%. Fast forward to today, you're down at 3.66%. When you look at 30-year mortgages, a week ago, you had spiked last Wednesday. The average 30-year mortgage rate was at about 7.05%. Fast forward to Friday, that had dropped to 6.75%. Yesterday, 30-year mortgage rates were down to 6.57 to 6.53. Today, they're about 6.75%. So you've seen a dramatic reduction in yields as a result of the banking crisis, or trying to rationalize if there is a banking crisis. 2-year treasuries, just amazing that on Wednesday, Thursday, 2-year treasuries were at 5.05%. Yesterday, they dropped to just over 4%. So you had the biggest 3-day decrease in yield since 1987, which is just amazing to think that, a short-term treasury note could move that fast in that short amount of time. So where I'm going with all this is that this is going to be perceived to be good. Rates are starting to come off from a housing standpoint. Ideally, we want to see 30-year mortgages go back to 6.5%, 6.25%, 6%. I think what's being lost out there is you're going to see U.S. banks, all U.S. banks, doesn't matter if they're national, if they're regional, it's going to be a risk off as their financials are heavily scrutinized internally, externally, by shareholders, doesn't matter. You're going to see banks go risk off here. They're going to analyze who they loan money out, who they've already loaned money out. They're going to analyze their balance sheets, and they're going to have to prepare, especially some of these, when you go back to some of these higher risk banks on this list, when you go far right, these are high risk banks. They're going to get overanalyzed to the nth degree. So the trickle down effect, and again, this is my opinion, you guys can chime in, I'll stop talking, I promise, but your less is more. Banks are going to be more reluctant to loan out money if it's going to come under scrutiny who they're loaning money out to and what they're doing with that money to generate revenue. It's going to be a risk-off scenario for the U.S. banking industry until you legitimately get through this crisis and find out who legitimately is worth something, who can backstop themselves, or who's just another cockroach in the cabinet.
I think it's important for everyone to understand why the interest rates have gone down on notes, which is people that had cash sitting in a bank went, oh no, that's not where I want my money. I want my money into something secure that they can't steal from me, and they put it into a treasury note. So they basically want to loan their money to the government and not anyone else.
Yeah, so that's spot on, Mike. You have a massive increase in demand. So as you get an increase in demand, bond prices move higher, yields move lower. And that's exactly what you had, is this flight to quality. You saw it in gold. You're obviously seeing it in Bitcoin for whatever reason, but you saw it like, again, this in theory this is a risk-free return as long as you can hold it to maturity. And
Well,
that's what you've seen play out here.
Somewhat risk-free. The note has the notional value of $100,000, and if you paid 110 for that, you're still going to lose that 10,000 over.
Yeah, no. Well, but again, it's I'm going to lose the 10,000 to know that it's sitting there, and I'm going to make my 1%, and that's exactly what got SVB in trouble. And they would have been fine if they didn't have a run on the bank. Holding these to maturity still would have done what they had intended when they put these on. They just got exposed, and when you have a liquidity crunch, what's liquid, what's not liquid. And when something's not liquid and you have to go make a market for it, we've all seen this in lumber. You can always find the market. You just might not like the pricing to come out. So
you did just use flight to quality and Bitcoin in the same sentence.
Yeah,
I just want to point that out. That's on the record. This is taped. The one thing I would say from the Canadian side is we've been maybe a little bit ahead of what's going on down there, and they are expecting rate decreases to start up here, which the only important part about that is Canada is 1/3 of all spruce SPF. So we're going to start seeing rate decreases up here pretty quickly. And, who knows, it's hard to say what the effect of that is, because as you said, Greg, the chances of us dodging a recession when the banks won't loan you money to, buy a barbecue is probably going to lead to a recession.
Yeah, and so how I think this trickles down into housing. Look, you're going to see, if you can legitimately get mortgage rates to move down and you can qualify and you have the comfort level to go buy a house, that's great. Maybe you get the initial kind of tailwind of lower rates into single family. Where I think this gets a little bit more murky is the multifamily component, where banks are going to look at credit lines and they're going to see money sitting there that's not being utilized. And they're going to say, wait a second, lumber is no longer $1,000. Lumber's $350. Your sales are off dramatically. Do you need this credit line? And the easy answer is going to be no, because you're going to have banks heavily scrutinize anything and everything now. And so from a multifamily standpoint, I think there's going to be a lot more scrutiny. We all know that we need more housing, and whether you rent the house, you buy the house, you need more housing. This analysis that rates are coming off is beneficial is a giant red flag for the economy that probably ratchets up the probability that we are going to go into a recession. This is just one more piece of the puzzle that the Fed didn't want to have to deal with, that they now have to deal with. You want to talk about sleepless nights and making hard decisions going into 322. That's going to be Powell and the Fed governors in trying to analyze, is inflation no longer important now? You're going to find out how real they think the banking issue is by what they do or don't do with interest rates. If they raise rates, then they're saying they don't think it's a big deal, it's contained. If they don't raise rates, that could be a big flag that they see some headwinds out there that need to be addressed. So it becomes a thankless job for our FOMC in what they do with rates here moving forward.
I mean, they really are in a bit of a pickle, because the prudent thing to do is let's just wait a month. Let's not do anything. It's a month. I think we can all survive. But does it signal something like you're saying, where maybe it appears they know more and that they're concerned?
Yeah. And again, the big issue, Powell literally just spoke to Congress last Tuesday and Wednesday and clearly laid out, we're going higher for longer. and then, said inflation is still, we had CPI out today that was basically up 0.4% on core. It's in line with expectations. You are seeing signs that inflation is moderating, but are you just going to shelve that whole inflationary approach now? And that becomes critical, and how and what they see from a risk standpoint now. So something to watch going forward, and then we can jump into to
The one
lumber.
thing I want to point out, we sit here every week and we look at some of the same data over and over and over. That's always the known, but from a trading strategy, it's these unknowns. It's the fact that a bank just got blown up last week. You can't see that coming, obviously. So that's why it's more important than ever to know your data and know what's going on in the market. So when a new piece of data comes in, you can make an analysis of it, talk through it. I was under the impression that this is going to be good for housing because interest rates come off. And I hadn't thought about kind of some of the stuff that you were just saying, Greg, where, that it's probably more of a squeeze on overall business, meaning they're going to start taking credit lines away. And if the banks go seriously risk off, which they can, then there won't be that liquidity to do business. So
and so I think it's going to separate the haves versus the have-nots, and that some of the people that deal with some of these peripheral banks, the regional banks, some of the higher risk banks, there's a reason. Those are the people that'll deal with you. If you're A++, AAA rated, life is good, you're probably not going to see much change in your overall business structure. The bigger banks are still going to want to deal with those customers. It's the customers that might be A- to B+ or lower. Do you still have a captive audience from a banking standpoint? The answer is all banks are going to heavily scrutinize everything under the sun because they have to now. It's not a question of if they want to, they have to where you can't say that there's no risk in the industry, especially when Moody's cuts, U.S. banks. That's something you just can't set aside and say it doesn't matter at this point.
The canary in the coal mine for me is to see how the Silicon Valley Bank assets get bought or what happens with them.
And
I was a little
interestingly
surprised.
enough, a lot of big banks looked at them and have yet to pull the trigger. And that tells me, I've got buddies, some higher ups at banks scattered throughout the U.S. And that was the glaring thing, that it wasn't an obvious. Somebody stepped in and saw this is the greatest deal in the world. So some of that stuff that's out there, some of those deposits out there, risk to reward. There's a reason a single bank hasn't picked up, or why haven't banks picked that up yet? I you don't want to overanalyze that, but there could be a reason why it's not that obvious to say that there's value in that right now.
Exactly. So that's what I'm watching for. Now, look, I do know Silicon Valley Bank was a very unique structure in some of the assets they had on. So maybe that's part of it, but the reality is no one has bought them yet.
All right, I'm going to do less talking now. Let's shift into lumber. We've got March expiration, and it's almost to a T playing out with how January went off, where, January expiration was 344. We filled that gap today in March. March legacy traded down to 340.20. The mini traded down to 435, which is the equivalent of basically a 335, basically in that 330, 335 area. So you filled the January expiration gap. And of course, March is kind of stumbling around. Last trade in March was a 359.90. May's making new highs now. So, again, we don't want to deal with the reality of today, but when we look down the road, we see better times ahead. And that's kind of when you look at the differential between March, May, that spread traded out to negative 79.40. The March, May mini traded out to negative 75, where, you know, again, nobody really, cash is your best buy. But you know, I think people, again, are being good deal to death with physical cash. The interest to take March from an EFP standpoint, everybody's kind of more fixated on the what if scenario with May. And you know, of course, May's up a lot. You know, May just made new highs here at 420, 470 now.
So, Kip, why are people not jumping on this $70 basis in 2 months?
Well, it's I mean, if you think about it, you can buy cash at where March is. Depending who you are, what mills you deal with, you can buy it around there, which is kind of why it's going to expire there. You sell the May, and let's, you know, everyone uses, well, it's 2 months. Well, it's not 2 months because you also have to sell the wood.
Of course.
So let's call it 3 months. So let's just use $30. You put the wood on the ground, a little bit of interest, you get charged. That's $30. So if you buy cash right now, or the board, they're similar, and you put it on the ground, you're in sometime in the end of May, you're going to have wood for sale around $300, roughly, maybe $295. That is going to be your cost if you actually put it on the ground. You're going to pick up $45, $50. How can you possibly miss? You can't. I mean, the world has to melt down if in 90 days in the middle of spring after a tough winter, right? If you cannot sell, like, if $300 isn't a good cost for your wood on the ground ready to truck tomorrow, well, I guess things will be pretty bad. But you know, are the Euros going to pile wood over here at $300? That's selling, so that's $200 Europe. I don't think so.
Yeah, like it's
It's a no-brainer to me.
It is a no-brainer. Now, is it people
Yeah.
just don't know what to do?
Well, it's not that hard. You just buy cash from your favorite mill. You'll get a bit of a discount, or take delivery, which, you know, the usual 20 suspects do, and sell May here. You are going to have $300 wood at the end of May on the ground that you can ship to your customer.
Well, how about you tease it?
I think
Tease it a
that's a
little bit and
bad
sell
deal.
July.
Hmm.
July's
Well, that's
giving you another $20, right?
Yeah, I kind of use in my head between, you know, the reload, the, you know, interest, and, you know, not wanting wood to sit forever. I kind of use like 10 to 12 bucks a month.
Okay.
And you have to use an extra month because you have to sell the stuff, right? It's not like March 15th, all the wood's gone, or sorry, May 15th. It doesn't quite work like that, right?
Yeah, and so I know, and this, Kip, this kind of alludes to what you're talking about. Full carry for May right now should be about $20. When you look at March to May or cash to May, and you know, again, this is as of last week, which referenced a spread of $50. You know, that spread right now is negative 62.10. It's traded out to negative 79.40. So from a cost to carry standpoint, you know, you're upwards of 200 to 250% over where you should be from a cost to carry standpoint. And that just says that cash is that much cheaper, futures is that much more expensive. Somewhere in the middle lies the truth. And if you can see this to fruition, you know, this cost of carry, you know, to be 50, 60, $70 over really denotes a physical cash price of probably $600 a thousand, not $350 a thousand. So again, watching May kind of stair step higher, we know that when January went off at 344, I think the expectation was that May or March would collapse back in somewhere, you necessarily wouldn't fill the gap right away, but you would come back down and get closer to Jan expiration. You had the commodity fund short covering in March. March traded as high as 530 before it ultimately settled back down and collapsed lower. So, this is the difficulty from a basis standpoint. You could be buying something in the form of physical cash that you're going to have 100% cash outlay. It's not going to ship until this date and time. And then once it hits my yard, I have to sit on it and wait for the convergence to take place. And that convergence could be a month, 5 weeks. It could be well off into the future. And I might have to margin futures, especially if you get a rally in futures. You know that if the market rallies, futures is going to rally first. It's going to attempt to drag cash into the fray. So, these are the hiccups in doing a basis trade, where I have to sit on the physical wood. I might have to endure margin calls on the future side, but ultimately, like Kip, you're going to get the convergence, especially if you're buying mill direct. You're going to get you're going to get convergence, and we've seen that play out in January. We saw it play out in March. May is not going to be any different. There's nothing special about May as to why it would be different. It's just what's your patience? Do you have the ability to sit on the physical wood and margin the future side until you get to that point where convergence takes place?
Yeah.
We have roughly a similar. I mean, unfortunately, we don't have the COT report. It's a little out of date, but I would be willing to bet that we now have 1,500 shorts again, and the commodity funds. And what kicked it off last time was Canfor announced a pretty serious curtailment, 2 mills, which we're going to see in April. So by May, they're going to be missing a fair amount of production. And then the commodity funds started covering. Well, if we're at $350 and kind of appears that's where we're at, I will bet anybody that by May 15th, we will not be at the production we're at right now, not including Canfor going away with 2 mills. I mean, on top of that, we will not, whether it's, the Eurowood or, shutdowns in the east, west, whatever. And if that sends off the commodity funds covering the shorts, the exact same thing's going to happen. There's no reason to think that it's going to be different.
Yeah, and this is what Kip was the managed money component. You're saying Kip is up probably closer to 1,500 now, real time.
I'm sure it is.
Yeah. And so Kip is saying that this number, amazingly, we watched back in January, the funds had this massive short position. You had a big size, you had a big shift in interest rates where you went from 7% back down to 6%. To me, that was the biggest catalyst of anything outside of the funds just wanting to take their money off the table and go home. That was the biggest reason probably why funds short covered. That led to a rally in March up to 530. That managed money component almost went down to 200 contracts.
Right.
Yeah.
And then as interest rates started to float back higher, you had this reemergence of the commodity funds, where the funds kind of have that short-term memory where or there are new funds to replace the old funds, and that's kind of where I'll go back to. Here's the here's the May chart, and here's that rally. Here's that short covering rally in March. So March again. Here's March going into, and again, this is a March daily continuation. So here's January expiration at 344. March at that time was basically in the same area, a 415. You had the fund start to short cover in a very short amount of time. 6-7 days, you went from 415, you spiked up to a 530. cash engaged to a point, but you really didn't see signs of robust demand where this was your short squeeze 101. The second you didn't get the follow through buying by the funds, the second that stalled out, you had this kind of ensuing collapse back to reality. And so, the bigger question for me is, can you replicate almost the same exact thing in May where you have the missing ingredient now is there with the commodity fund shorts? Do you get another announcement, the what if scenario where you could get another, again, if we're going to bounce, futures is going to bounce first and try to attempt to drag cash into it. But whatever the upside potential is, and here's the May contract right now. So we're up to 426. So you went from, I think we had 9 days, 9 to 10 days at this 9-day moving average. The Bollinger Band high, Bollinger Band low were starting to contract. So can you break out here in this 430 to 439 area? That's probably an area where maybe commodity fund shorts would start to get stopped out and go to the sidelines. So it just sets the scenario. Can you get another short squeeze in May, push to the upside? But for this to be sustainable on any technical breakout to the upside in futures, you got to have underlying physical demand. It can't just be, you can't solely be relying on the mills taking supply curtailments, taking wood off the market. As you attempt to stair step higher in prices, it's the demand component's got to ratchet up to fundamentally support that. And that's a big if right now. Where it certainly would help if interest rates went lower and stayed lower. But if interest rates are going to be stuck at 6.5% to 7%, is there enough underlying demand to support any breakout higher in futures? The answer so far is no. Does that change? That'll be, for me anyway, that's what I would be looking at for me to give me comfort that something has changed in this market. You get a spike up in futures, you don't come collapsing back down to the recent lows, you're able to stair step higher and then fundamentally see demand kind of come back in to support these higher numbers. And so, the curtailments, aggregate curtailments will mean something someday, but do they mean something today? They only mean something if the demand is there, if the demand engages, the churns increase, and people can start to, churn wood and get out from underneath the excess inventory, the prompt wood that's out there right now. And that, I think we've talked about this. It just takes time. To me, this is less about pricing and it's more about the timing of just chewing through all the excess wood that's out there right now.
Does the jump in that managed money open interest surprise you guys?
Yes.
I'm a yes. I'm a big yes.
Yeah.
To me, yeah, no, absolutely. And to me, the only logical explanation is that they're just watching interest rates. That's the only thing the funds care about as far as trying to gauge to be bullish or bearish housing, is just watching interest rates, watching that 30-year mortgage vacillate back and forth to where as that comes off, they come out. As it goes back up, they come back in on the short side. But there's no other, as far as I don't have any other rationale what they'd be watching to suggest otherwise, because, this is, if you just look at the chart, to go from the low in March was 360.60. They sold down to those lows, 360.60. They short covered up to 530. They didn't start selling again at 530. To go from 530 back down to what? You probably took a good $70 to $80 of the commodity fund longs getting annihilated out of the market before the funds started to sell again. So the funds realistically probably started to sell in this 450, 430 area in March to roll that position into May, and then to be back in this position is just insane.
What it tells me, and we know how fickle they are, and I think this is where Kip was going. We're on a powder keg here. Like any pickup in demand, any reduction in supply, any reason for that managed money to pull their pull their shorts.
or more likely, Mike, a combo thereof,
Of course,
right?
right? Those
It'll probably be a little bit of both. Like Greg said, we do need, yellow pines, starting to trend higher. 2x4s are selling. Hasn't happened in spruce yet. I think we need to get March out of the way. But you need a little bit of both. We can't curtail our way to $600 lumber. But if the takeaway picks up, and maybe it's weather related, maybe it's a little bit of interest rate, mortgage related, and then you also have the curtailments that I think we all think we're going to see. Then I think, yeah, we are. I mean, you could go $350 is not a reason to make more.
Right.
It's a reason to make less, and they will.
or load more vessels in Europe.
Well, I think that the problem with that is you start looking at some of the prices that have been taken on the Eurowood, the actual price, and then you take off $30, let's just say, for port related stuff, and then you take off $80 to get it back to the mill, something around there. They're selling wood at sub $300. That's not going to last forever. There are other, like I can remember back in the day dealing with some European mills, and they would have like 42 different countries they would sell to. Like it's not like Canada. We have like two or three.
Yeah,
Japan,
and I think
China, the US. It's
you mentioned this.
They can go everywhere.
Yeah, and I think Kip mentioned this yesterday when they, like again, selling to the U.S. That's a specific run in the mill. It's a specific log where you're going nowhere else with that wood. Once you commit to the U.S., then that's it. You've got to just move off that finished good inventory that you're going to the U.S. with that wood until it's gone.
Yeah, everywhere else in the world, I know this is a newsflash for you guys, but everywhere else in the world, they use metric. Once you cut 2x4, there's only one destination.
Hey, come on.
I'm just saying.
We use
Don't shoot the
metric.
messenger.
We use metric. We've got like 2-liter bottles of soda here.
Nice.
We're right on the cutting edge.
That's good stuff. So yeah, I mean, when I look at lumber, realistically, you're stuck in this 489 to 321. 321 is an expiration special. 489, maybe you can get exceed that by I don't know, $5, $10, $30. But to sustain a breakout in either direction, look, if you're going to break out under 320 and stay there, you're in a hard recession. There is no demand. The mills don't curtail. That's probably unrealistic. For me to be a believer that you belong above this Bollinger Band high, look, the supply side curtailments have to continue, but more importantly, you got to engage the demand component here, and the demand's got to surprise to the upside in both single, multi, all of the above. And I just, from a timing standpoint, that's probably down the road, but it just doesn't feel like it's today, or there's very limited evidence of any that it's today.
So what if we go sideways? What if nothing happens for the next until May goes off the board? What's the strategy?
I think it would be a rarity for lumber, but it's certainly a possibility. I think it's okay, and you are starting to see. So I'll give you, if you're a believer here, you're stuck in this range. Then as you get to the lower end of this range or the higher end of this range, you're a buyer, you're a seller. If you think you're stuck in that range, and you are gradually starting to see more options trade here. I don't know if you can see these. You're a seller of calls, you're a seller of puts. On the weakness, you're a seller of puts that get you the low end of this range. On the rallies like today, you're a seller of calls that get you the high end of this range. And you're writing options on both sides. And if you're stuck in a range, you're just going to collect on both sides.
Well, I can definitely tell you the option pricing volatility has come down. Options were trading around probably a 40 vol for the at the money stuff today. But it makes sense because there's less opportunity. Well, I should say the movements will be less than what it had been in the past 2 years.
Yeah. So, from an open interest standpoint, LBR is up to 1400 now. The mini, you're officially running out of contracts in the legacy now, where this is it. The May is the only game in town. And just when you look at total open interest, to see this market unravel the way it has, open interest has held its own. So whatever long liquidation has taken place, it's obviously been replaced by the short side. And I think that kind of supports the idea, like Kip mentioned, that this is up around 1500. Yeah, I think the funds have chased the momentum lower. And again, if you stall and if you fail to make lower lows, then you could run the funds out of this market again. That could give you the spike to the upside. That could widen that basis opportunity, Mike. But I guess you want to be a technical trader. All I would say with all markets right now, especially in a risk-off environment, I would be very careful adding positions, chasing momentum in any market, lumber included.
Agreed.
Chasing momentum, whether it's equities, treasuries, energies, precious metals, Bitcoin, lumber, in a heightened kind of a heightened level of volatility, of uncertainty, chasing momentum is a recipe to just get taken to the woodshed.
So, all right, let's wrap up. I think the key takeaways are keep your finger on the pulse of interest rates, and liquidity is key. This is potential frustrating market where we don't go very far, but you lose on every trade because if you start chasing, like you just said, Greg, you chase and no one follows you.
Yeah. And when I look at, May today, are we going to hear rumors? Does somebody know something? Is somebody short covering May because they think somebody's going to make an announcement? Without that kind of news, then there better be some activity in cash. You better be supportive that you're going to see tonight's Tuesday. Are we going to see the low end of print tonight?
Or this could be the managed money saying, wait a minute, if interest rates are driving my decision, interest rates just told me we're pulling back.
And at the very least, when you look at interest rates, whether, it doesn't matter what side of the aisle you fall on, it's bearish, bullish, because of the risk, whatever, you technically had a massive reversal off of the high end of rates. The entire yield curve reversed from 2-year all the way out to the 30-year. So if you're a technical trader and you just watched rates give this key outside reversal across the yield curve, that could be reason enough to go to the sidelines.
You would start covering shorts, right?
Yeah.
If you're interest rate driven, you have added this huge position at very, very low numbers overall, which I don't know if they even know what Random Lengths is. But if you are interest rate driven, in the last couple of days, we have continued up in the May, not hugely, but maybe they are starting to cover.
Yeah.
It's possible.
Yeah, well, they just did it. So, I mean, to say that it's not, I always equate commodity funds that trade lumber to when you think that it's not rational and can't be done, it's the hold my beer moment. Yeah, oh yeah, watch this. Where they don't have to, obviously we do this deep dive, the micro analysis into our markets. I think lumber being such a boutique small market that it is, I don't think the funds, do they spend more than 5 minutes a day, 2 minutes a day thinking about lumber? The answer is probably no. It's risk on, risk off. We want this exposure. We don't want this exposure. Okay, we don't want the exposure. Get out. How do we get out? How many can we get out a day? Doesn't matter. Just get out. And I think it's that simple when it comes to the funds entering or liquidating positions in lumber futures, where we like to do the deep dive analysis. I think at the end of the day, the funds, this is just a very small piece of the overall puzzle and how they trade.
Agreed. All right, gents.
Okay.
Until next time.
Yeah,
All
good
right.
stuff, guys.
Thanks, guys.
Appreciate it. Thank you.
Have a great week.
Take care. You too.